Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In this video I'm going to share with you guys one company that is a dividend growth company. They're a high growth company, have been around for quite some time, and I genuinely think it's the time we look at this company. We haven't done it in ages. A lot has changed over the last few months, and as you know, the stock market is going up a lot. And so what I want to do right now is just to kind of give you an overview of this company, and stay tuned for until the end, so I'll tell you exactly what I will be doing with this company because I do own it in this portfolio. Like I said at the beginning, this is a dividend growth company because they're growing that dividend for quite some time. They are in technology sector, and that company we're going to talk about today is a company called Qualcomm. Qualcomm is a leading company in wireless technology. They design and develop manufacturers, software and other technologies that enable fast and reliable wireless communication. Their products are used in many different devices, including smartphones, tablets. So if you look at your Snapdragons on your Samsung phones or whatever, that's the company that designs them. You can find them also on tablets, so you can find them on laptops. And Qualcomm is also a major player in the development of 5G technologies, and they hold a lot of the patent that have been used around that sort of a technology. So it's one of the best out there when it comes to what they do, and I feel like they are, it's time we look at them again. What you see right in front of you right now is my portfolio, and as you can see, we're just right now just over £118,000, which is absolutely amazing. About 20,000 up or 20% up right now. So we will see how it goes. Like I've always said to you guys, I'm going to share this with you guys whether it goes up or down. I think just this week we're up almost to £2,000. I'm sure last week it wasn't that. Whatever it is, I'm going to share with you guys as we go along. You can see this split here. You can see basically the portfolio itself, and you can see the ETF. So the ETF is just over £1,000, and that, to be fair, is the highest I've had for the last 3 years. My ETFs used to be about a couple of £100, but I'm starting to grow it every single week. I'm buying more of these ETFs as we go along, and I'll share of course I will share that with you guys. So the first thing we're going to do is just look at the company's recent basically how they're doing recently. So Qualcomm is this company that we're talking about today, and as you can see, a year to date is just up about 10%. If you compare that with the rest of the semis, they've done absolutely nothing in comparison to what Nvidia's and Broadcoms and so on have done. But when you look last 6 months, this is the bit that shocked me, and this is one of the reasons I decided to look at it, because the company is now heading towards the 52-week low range rather than the 52-week highs. The highs was $230 per share, and right now basically is let's call it 160, and 135 is the lows if you think about it. Now 6 months is down about 26% or to almost 27%, which is absolutely crazy. But I say it's crazy, but it's absolutely amazing for long-term investors to then look at this and say, okay, maybe this is a great opportunity to buy. And as you can see, Wall Street and Seeking Alpha Analyst both agree it is a buy right now. So what I'm going to do now is just go through the latest earnings quickly. Then we will look at the financials. Then we will look at the discounted cash flow models that we used to see if basically this company is a buy or sell. And I will tell you at the end what I will be doing with the company. Okay, so this is Q basically 4 and of 2024. So they start in about 2025 next term. As you can see here, the revenue basically for this quarter was $10 billion, and you can get this split here. So QCT and QTL is how they report, and others. And as you can see here, this was $8.7 billion, and this was $1.5 billion. Okay, and of course, both of them combined together, that's basically what you will get. So if we look at these I'm just going to skim through this, a lot of them. Okay, so the revenue comes from handset, automotive, and the Internet of Things. So you can see this is 6.1. So the handset, the mobile phone side of things, Snapdragons or whatever, they basically are the main bread winners if you think about it. And there's about basically about $1 billion of automotive coming from the automotive. This is the bit they thinking they will grow a lot faster in the coming years, and the Internet of Things is $1.7 billion right now. Just to kind of break things down, as you can see here, we've got the revenue that we just talked about, so that's up about 9% quarter to quarter. So this time last year, basically where they were also from last This is a fiscal year of 2023 to 2024. So you can see $35.8 billion. That's what they made last year. This time they made $38.9 billion. And that's where that 9% plus revenue came from. EBIT, as you can see, is actually growing about 20%. Okay, and EPS is actually growing about 21%, which is absolutely amazing. So free cash flow is basically right now $11.2 billion. And I think this is, for me, one of the most important part. Companies will basically make money. Then they will, of course, spend some money on, you know, all the overheads that the company has. Then they will pay all the taxes and so on. And then you've got basically EBITDA or whatever is left. And then you've got the net income, or whichever you want to use. And then the free cash flow comes in. The free cash flow is the money the company uses to pay us the dividends, to buy back their own shares, to pay any debt, to acquire other businesses. So it helps the business and shareholders, of course. And that is really the most important thing that I look for. Yes, you can make money, but what is your free cash flow looking like right now? So if you're learning to analyze stocks, put a lot more emphasis on the free cash flow side of things, because that will give you the full picture if you think about it. This is the breakdown now. We're looking at basically the different segments. So QCT was up 9% and QTL was up about 5%. Again, I have no basically doubt this will continue in the next few years. If not, basically it will be even better. And I will share with you guys what the analysts are thinking about. Now let's go over. We've already said the company works in basically is the semiconductor company. Qualcomm, $158 per share. EPS right now $8.95. 175 billion market cap, and it has a narrow economic moat. I have a question mark next to this, and I've always said this every time I do analysis for this company. I've always said to you guys, this is the bit that just annoys me, because this company has a patent that other companies actually pay for royalties to use. For me, that should be enough. Okay, that should be enough. The fact that basically to companies like Colgate, he's got wide economic moat, but this company hasn't, which just makes no sense to me. The beta is quite high, and basically that means it's just a bit more volatile than just general markets. And when we look at the current PE, it's about 17. The forward PE is about 14, and the 5-year average is 19. So the company right now is trading lower than the 5-year average, which is very good. The sector medium right now is about 25.7. There's a lot of that because of the Nvidias and Broadcoms and all of these companies that are high flyers. Okay, so when you compare, because they're all in the same sector, you're going to have to compare them. Right now, they have a dividend yield of 2.13, which is still growing, and the payout ratio is only 32%. You get $3.40 for every share you own, and the 5 years is basically 6%. The 5-year growth rate 6%. Normally, that's what I'm looking for. The dividend streak of 21 years of increasing. That 4 more years, this company will become a dividend aristocrat. The safety side of it, we're looking at that basically if you're using Seek and Alpha, A+ is the highest. This got A-. We have $11.1 billion of free cash flow. We've already seen that from their latest earnings report. The free cash flow for the compound annual growth rate for the last 5 years is about 12%, which is really good. Free cash flow margin is about 23%. Now that is really important. Basically, this kind of helps us understand how much of the basically sales are left after the company has paid for all their stuff that they need to pay for, including taxes and so on. The 23% is very, very good. I've increased this from 5% to 10%. Anything 10% we are comfortable, but 23% is very good. Profit margin, operating margins, return on equity, and return on invested capital. There's not that many companies that can have this type of basically profitability and management, competency of the management and so on. The net income, the compound annual growth rate for the last 5 years, we're looking about 24%. Total return in the last 10 years, and per annum, we're looking about almost 10%. And the revenue compound annual growth rate for the last 5 years, 12%. EPS about 44%, and current ratio is above 1. Now, the reason this is basically above 1, we're looking for anything above 1 is because that means they can cover their current liabilities. So current liabilities, current assets, you can easily find if you go to places like financials on the Seek and Alpha, and then go to income, the balance sheet. Two things that you're going to see. So the first one is the total current assets. That's $25 billion. And then you need to look for the total assets, which is $55 billion. And then total current liabilities is only $10 billion. So they basically have more current assets than liabilities, hence why this is basically what it is right now. Okay, so growth estimate for the next year, they're expecting 9% when it comes to revenue. EPS growth, they're expecting about 10%. By the way, if you're enjoying the content so far, it takes a lot of time and effort to put these videos together. I would genuinely appreciate if you can join us to the Patreon account, where you get access to the Discord and you get access to all the things that I normally share, including the buys and sells from the family portfolio, this portfolio, as well as the undervalued stocks that I share with the community, the watch list which I've updated a couple of days ago, and so on. Apologies, I'm going to update the trackers. Okay, I've got time off inshallah in this December, so I will be updating some of the trackers. And now there's one or two brothers who've kind of messaged me about a couple of errors that they found, so I will be doing that inshallah. Right, going back to this, currently we can see is fairly valued according to Morningstar. They think the price should be about $180 per share. Right now it's 100, and let's call it even 160. So you're $22 apart, basically lower than where they think it should be, which is quite nice. According to Simply Wall Street, it's 45% undervalued, $290 per share. I wish it hits that. 230, I think, was the highest that I've seen. Now they're very much bullish on this company. I think they've always been. When it comes to for the next 12 month price target, they're thinking almost $200 as well. 200, basically 26% upside from where we are right now. Is a moderate buy from them as well. Average price from Seeking Alpha is 205. So they're taking all the analysts and averaging it out, and 30% upside from where we are, and it's a buy from them. Now, in terms of Sharia compliance side of things, there is no issues with this company. A couple of more things I want to share with you guys. So when it comes to ordinary shares, they are declining. So 1.1 to 1.1, again 1.1. So they are slowly declining, but not massively. So they are buying back their own shares. Repayment of debt is also getting better. Okay, so they are buying back, they're paying off debt, they're repurchasing. So this is how much basically they spend. So $3 billion, almost $3 billion, $4 billion of basically buying back those shares, which is quite nice. And as you can see here, the free cash flow from $8.6 billion to right now $11.1 billion of free cash flow, which is growing. So that's just for the last 4 years, and the trailing 12 months basically is almost identical to the current basically 2024 data. So that's basically the what I wanted to share with you guys. Now, what we now need to do is compare, basically look at the valuation side of things. Okay, so as you can see, the company is Qualcomm, 108. We've already seen that. We've seen Simply Wall Street, what they've said. We've seen Seeking Alpha. I used the discounted dividend discount model, multiple valuations, and discounted cash flow model. I managed to do all three, as well as the other three, average all of it out. We ended up with $217 per share. This is what is diluting the whole thing, because that is just $290 per share. If we take that out of the equation, it's about 200 where they will think, but it doesn't matter. Okay, 217 is what we get. Current price of $158 per share. That's 37% upside from where we are. Now, if you think this company is very volatile, which it can be at times, and you want a 20%, you still basically can buy this stock right now for $173 per share. I'm not saying go away and run and buy it straight away. Of course, do your research and find out more information about the company. Learn about the company. It's a very cyclical business. Okay, when there is demand for the technologies this company creates, of course, then there is booming, and there might be times where that doesn't happen. And I remember a few years ago, if you were here, put on the comment section. I remember us talking about it, and we remember they had when it comes to the growth side of it, okay, this was minus something, negative something, I can't remember what it was. But yeah, so that's basically was the case. But right now, basically they're expecting it to grow about 9-10%. And not long ago, about 2-3 years ago, they were saying it's going to be a negative year for this company. So just be mindful with that, please, okay, as always. And don't just take my word for it. Do your own research, inshallah. Now, just the only thing that's left is to compare it with the companies in a similar sort of a sectors. They might not do exactly the same thing. A lot of these companies kind of overlap some of the things. But these are we're comparing it with Micron, we're comparing it with Broadcom, as well as Texas Instrument, as well as the S&P 500. And what we're looking for is the total return. So the last 5 years, this company has returned almost 100%. The S&P 500 about 90%. Texas Instrument, we can see it about 74%. This one, of course, they've been absolutely amazing, over 500%. And because of a lot of the AI recently, that's just gone absolutely crazy. Look at that graph in comparison to the rest of them. But you can see the rest of them are more or less similar. This is the outlier. This is the one that's slightly different. When you look at the last 10 years, you can see Broadcom is about 190 something, 190 the S&P 500. It's more or less trading what basically returned what the S&P 500 has returned. The rest of them have done slightly better. Well, this one is done slightly better. This one is done really, really good. Whereas this one over 200%, which is absolutely 2000%, which is absolutely crazy. So if you are planning to buy this company, please just be mindful, okay? Just don't just buy it because we talked about it here, and I'm going to share with you guys now how many shares of this company I own and so on. So I own 30 shares right now, £3,755, 27% up, or £810 right now. So a lot of that basically was, and I think I started buying this company very, very long time ago. I think it was around 2020 or 2021 was one of the first few companies that I've actually invested in. So since then I've been actually buying. There we go, August of 2020. 2020 is when I bought my first share of half a share of this company. So yeah, this is why I always say to you, buy high quality companies, hold them for a long time, leave them alone, and inshallah they will grow to become one of the basically best performing stocks and so on. Don't go in and out of stocks, inshallah. Anyway, that's what I want to share with you guys today. Have a wonderful day. Join us in basically Patreon account if you haven't done it already. Assalamu Alaikum.